Hi students, I'm Stacy Perkins with Legacy Education Alliance, and I'm happy to bring you a brand new edition of Legacy Connection, your connection to Legacy's most shared and engaging content for this month, spanning from real estate and foreclosures investments to financial markets and currencies across the globe. Today, I want to talk to you about commodities. These goods, which compete in perfectly competitive markets and are identical across brands regardless of who you buy them from, affect our daily lives in one way or another. They include resources such as energy, metals, livestock, and agriculture, just to name a few. And they can be found on some of the top commodity and stock exchanges. So what are some of the ways of trading these commodities? Today we'll focus on two: derivative instruments and stocks. Trading with futures, a type of derivative, directly ties your performance to the price of a particular commodity. Either you are looking to speculate on the price of a particular commodity through futures or forward contracts, or you may be looking to hedge risk in some form or another. When we talk about trading stocks related to commodities, we are referring to public companies whose main line of business depends on a commodity. For example, this includes companies in the oil business or those that mine for gold. Arguably, stocks could also be used for both speculation and risk. They can be used for speculation in the sense that you invest in a particular company because you think the commodity tied to it will do well. On the other hand, you could be looking to hedge risk by investing in, say, gold, which reacts opposite to the overall market. More on that later. So, when it comes to commodity trading, what sort of strategies should we focus on? Again, we'll focus on two: technical trading and fundamental analysis. In our latest article on My Elite Portal titled Trading Strategies for Commodities, we discuss these in detail. When it comes to technical trading strategies, which deal with analyzing the historical pricing patterns of a particular asset, there are two major strategies that you want to use in the commodity market: range trading and breakouts. Range trading entails buying at the low end of a range and selling at the high end, or at least attempting to. Here you will try to time when a particular commodity is either overbought or oversold. For the former situation, you want to sell the commodity, whereas in the latter, you want to buy more. A breakout strategy involves timing deals that occur outside of the range we relied on in the previous strategy. Here, you will want to attempt to identify when the commodity will reach new highs or drop to new lows. The key is to identify strong trends among commodities and take advantage of them. The second commodity trading strategy is fundamental analysis, which deals with examining various factors that will affect the supply or demand of a particular commodity. Based on your findings, you may think that a commodity's price is likely to increase, or it could be the opposite and you think it will decrease. This analysis will help to perform the basis of your trades going forward. Typically, fundamental strategies occur over a longer term than technical ones. So which strategy is best? No one single strategy is necessarily better than the others, but it's up to you to decide which one you are most comfortable employing. Now I'd like to invite Legacy Education Alliance's CEO, Anthony Humpage, to discuss the relationship between currencies and the price of commodities. Anthony.
Thanks, Stacy. Hello, everyone. It's Anthony Humpage, CEO of Legacy Education Alliance. Before we came into the studio today, Stacy and I were chatting, and she asked me how it is that the dollar affects some commodity prices. And it's a good question. Because the strength of our dollar does affect some commodity prices, but not all. The best example, and you've heard me talk to you about this before, is gold. You know, as gold denominated in US dollars, the price will generally move inverse, that is opposite, to the value of the US dollar. So as the dollar gets stronger and it kind of buys more gold, the price of gold will go down. The key take home there is that that's because that gold was priced in US dollars. So what other commodities, for example, are traded and priced in dollars? Well, you probably buy one or more times a week, and that's oil or gasoline. So a stronger dollar will tend to push gasoline and oil prices down. But remember, all commodities are driven by the immovable law of supply and demand. If there isn't a demand for something, the price is certainly going to go down. And that's why today, if we look at the pricing of industrial materials, raw materials, and even agricultural commodities, over the last 12 months we've seen significant falls in the pricing of those just because there hasn't been the demand there. But if we have commodities priced and traded in dollars, the value of our dollars is certainly going to have an impact on the price of that commodity. And that's my thoughts on that. Once again, this is Anthony Humpage, CEO of Legacy Education Alliance, and thanks for watching today.
Thank you, Anthony. It's always a smart move to diversify your portfolio. So if you're a little light on commodities and looking to invest, then we certainly hope that you'll take some of the key points discussed here today into consideration. I'd like to end this segment with a quote we shared recently on social media. A little more persistence, a little more effort, and what seemed hopeless failure may turn to glorious success. Powerful words to keep in the forefront of your mind when times get tough. I'm Stacy Perkins with Legacy Education Alliance. Thank you so much for watching, and we'll see you next time on Legacy Connection.